Hello, and thank you for joining me. My name is Stefan Belholm, and I'm the founder and CEO of Prudent Wealth Strategies. This training is all about how you, as a real estate professional, can close more deals, get more listings, and bring more value by working with specialists to help clients pay less capital gains taxes without having to do a 1031 exchange. Now, 1031s may be a good option for some sellers, but they're not for everyone. So I'm going to show you some unique alternatives so that your clients can sell their properties quicker, avoid getting killed with taxes, and maximize their profits without the restriction of 1031 exchanges. Now, with everything that's going on in the real estate industry, as a broker, you need more tools to help clients and differentiate yourself. So I'm going to go over some unique strategies that you can introduce to clients today to help them mitigate capital gains taxes and at the same time differentiate yourself. That's what this is all about. Now, I'm going to be going over a ton of important information over the next 30 minutes or so, really from a 30,000 foot view. I'm not going to get too technical because every client is going to have a unique situation. And there are a lot of nuances when it comes to these strategies. Most of your clients have no idea about all the different options that are out there to mitigate capital gains taxes on their properties. So by introducing your clients to these concepts, you're not only going to make a big difference, you're going to build more value, and most importantly, you're going to differentiate yourself from the competition. So whether your clients are selling commercial properties, hotels, luxury homes, it doesn't matter. We want you, okay, not your competition down the street, but you to be the one to present these opportunities to your clients. We want to help you, help your clients keep more of their money and be more efficient. Now, before I get started, I want to let you know that nothing in this training should be viewed as legal or tax advice. So please consult with your tax professional or attorney when it comes to tax or legal matters. Now, quick background on me. My name is Stefan Belholm. I'm a tax strategist, and my office is located in Pinehurst, North Carolina, which is about an hour south of the Raleigh-Durham area. Now, prior to being a tax strategist, I had a short stint flipping real estate in Florida, which is where I'm from originally. And I know from experience just how much capital gains taxes can take from your profits. So when I talk to real estate professionals and their clients, I completely understand what they're going through. And what I do now is I work with a team of forensic CPAs, tax attorneys, and specialists that work with real estate brokers and tax firms all over the country to help clients that have significant capital gains taxes. So the agenda for this training is that first, I'm going to go over why strategies that only defer taxes, like 1031 exchanges, really aren't that efficient. And then we're going to explore some unique alternatives that will help your clients not only defer, but reduce and even in some cases, eliminate the capital gains. I'll talk about why most investors miss out on these opportunities and overpay hundreds of thousands and even millions of dollars in capital gains taxes. And finally, I'll go over how you can partner with our team to help your clients legally pay the bare minimum to the IRS, and specifically how you can get started with us within the next 30 days or less. Now, the Internal Revenue Code has contained provisions to mitigate capital gains taxes for decades, okay? This isn't new. This isn't some conspiracy that the government is trying to hide from you. You have 1031 exchanges and other variations like Delaware statutory trust. You have the Section 121 exclusion for primary homes, opportunity zones, and so many other things. But here's the thing. The well-educated real estate investors in this country don't use these strategies. They use much more sophisticated strategies, SPVs, trust, private foundations, all these different things, because they work with people that know that there are more efficient ways to use the tax code. And there's no reason why your clients can't do the same. There's a really famous quote from a former federal judge, Judge Billings Learned Hand, who said, "In America, there are two tax systems, one for the informed and one for the uninformed, and both are legal." So if your clients aren't informed, they're going to end up giving a whole bunch of money to Uncle Sam unnecessarily. And let's face it, one of the biggest reasons why a lot of clients don't sell is because of the tax obligation. And every dollar your client pays in taxes is a dollar that they can't invest in another property or real estate venture. They lose that dollar forever. They never get that back. And capital gains taxes are just the tip of the iceberg. You have the Obamacare tax, that's 3.8%. There's depreciation recapture tax of up to 25%. And depending on your state, if you live in a state that has state taxes like California, that's up to 13.3%. And then there's mortgage over basis that a lot of people don't talk about. But if you sell a property that has a mortgage, and at the time of the sale, if that debt is larger than your original cost basis, the IRS can tax you up to 39.6% on that difference. And I can go on, but the good news is that none of this has to be an issue for your clients. And they have options beyond 1031 exchanges to take taxes off the table when they sell their properties. Now, there's a big difference between tax avoidance and tax evasion, okay? Tax avoidance is legal, tax evasion is not. There's really no such thing as a tax loophole. You either participate in the tax code or you don't. Anything beyond that is just tax evasion. Now, there's no doubt in my mind that most of your clients are working with good tax professionals, whether it's a CPA, tax attorney, whatever. But if the only solution to mitigate capital gains is just to defer taxes, like with a 1031 exchange or DST or whatever, your clients are not saving taxes. They're not addressing the real issue. They're just putting a Band-Aid on a bullet wound. It's not that efficient. But when you start looking at ways to not just defer, but legally reduce and even eliminate some of the capital gains taxes, buyers, sellers, and brokers have a lot more leverage. And believe it or not, sellers can actually maximize their profits and net more money after the sale with a lower asking price than a higher asking price if they implement strategies to avoid paying the capital gains tax. It sounds crazy, but it's true. Let me give you an example. Let's say you have a property and the seller insists on listing it for $10 million. Now, most properties won't be like this, but to make this an easy illustration, we're assuming that there's no cost basis, so 100% of the final sales price is going to be subject to capital gains. Now, based on the market conditions, as a professional, it might take them a year to get that $10 million asking price. But it could sell quickly if they listed it at, let's say, $8 million. Like a lot of sellers, they don't listen to you and they insist on listing it for $10 million. Now, in the first scenario, the property sells at $10 million, but it takes 1 year to sell. And then the seller is left with $7.6 million after paying $2.4 million in capital gains taxes. In the second scenario, the property sells quickly at $8 million and the seller doesn't pay any capital gains taxes. Now, on the surface, it's only a difference of about $400,000. But assuming the seller could earn 6% on their money every year after the sale, in the second scenario, the seller would have about $10.7 million in 5 years. That's $700,000 more than what they originally wanted to list the property for. But if you look at the first scenario, same 5-year time frame, same 6% earnings, the seller would only have about $9.6 million because it took them a year to sell. So they had less time to invest and they had to pay taxes. So between the capital gains tax and that 1 year of waiting, the client actually lost $1.1 million trying to get a higher sales price. And the sad part is that they can never get that time or that money back. Time and taxes kill your client's profits. Time and taxes are the biggest profit killers for both you and your clients. The longer it takes to sell the property, the more you risk losing the listing. Yeah, your job is to get the most for your clients, but it's also to move the property quickly. So when you remove a huge chunk of that tax obligation, you can actually list a property for less, sell the property quicker, and your clients can get more money. But if your clients are just deferring taxes for a few years with, owner financing or 1031 exchanges, DSTs, whatever, they're not saving anything. They're just kicking the can down the road, deferring taxes for a few years. And how smart do you think it is to defer taxes in this current environment? Our government is in massive debt, and they won't stop spending money. We spent trillions of dollars in stimulus money and bailouts during the COVID pandemic. And most people don't know this, but in 2021, the government collected $500 billion, that's billion with a B, in capital gains taxes, almost double what they collected the year before. On top of that, the current administration has been very vocal about their plans to increase the capital gains rates and even tax unrealized gains. Now, all this stuff is just a prelude to what the government has in store. And even though no one knows what's going to actually happen, this should give you a pretty good indication of where our government is heading to when it comes to taxes. So it really makes no sense to just defer taxes. So if your clients want to be efficient, they really have to look beyond traditional strategies like 1031 exchanges, especially when there are so many different ways to not only defer, but actually reduce and even eliminate some of the capital gains. Let me give you 6 examples. Now, the first example would be to structure the sale where at closing, instead of the funds going directly to the seller, the buyer would send the funds to a third-party intermediary, very similar to a 1031 exchange. The only difference is those funds would be structured into an annual payout agreement, backed by a highly rated insurance carrier, so it removes all the risk. So the seller of the property would receive a series of structured payments that they can design any way they like, including future lump sums. Because the seller receives structured payments over time, they actually reduce the capital gains taxes, the net investment taxes, and any state taxes. And ultimately, with the interest that they earn from the payout agreement, the seller will get back way more money than what they initially sold the property for. Now, in this second example, with this strategy, your client would use a trust and an installment sale contract, very similar to what you would use with an owner financing deal. But the way that this strategy works is that your client would transfer the property to the trust in exchange for a secured installment note. But then the trust would sell the property to the buyer, then the sales proceeds would go to the trust. This way, the seller never takes possession of the funds and taxes are not owed immediately at the time of sale. Now, the trust can invest in anything from real estate, stocks, oil and gas, you name it. And then the income from those investments can pay the installment note. The capital gains tax can be deferred for decades, which gives the seller the opportunity to earn way more money over time and have more than enough money to pay the capital gains tax when it actually becomes due. Now, the third example would be to sell the property through a dynasty trust. And these are generational tax structures that pass on to your children, grandchildren, and so on. So because of this, dynasty trusts allow you to defer capital gains taxes indefinitely, really. And these are things that families like the Vanderbilts and the Rockefellers have been using for decades. Now, these are irrevocable trusts, meaning that once these properties are transferred to the trust, you really can't take them out. The way it works is very similar to the example we went over before. Your client transfers the property to the trust sells the property to the new buyer, and the sales proceeds go directly to the trust. Now, the seller never takes possession of the funds, so there's no capital gains tax due. But here's where things get really interesting. Because this trust can purchase assets like properties and vehicles that your client can actually use. So for example, the trust can purchase a property, your client can live in that property, and then your client can use funds from the trust to pay for property taxes, insurance, utilities, all with pre-tax dollars. On top of that, the trust can also defer taxes on passive earnings like rental income and stock dividends, as long as those assets are transferred to the trust. You can even shift income from active sources like LLCs or for contract work if you're self-employed. So this is a really versatile tax structure. Additionally, because dynasty trusts are irrevocable, meaning the seller no longer has ownerships of trust assets, there's ironclad asset protection in the event of a lawsuit. Now, charitable strategies are another very powerful way to mitigate capital gains taxes. But a lot of people dismiss the idea of charity because they think it means giving all my money away, right? I give them to a charity, I don't get to see my money, that's it. But there are several charitable structures that have significant tax benefits without clients having to give away the farm. So even if you're not a charitable person, it's still going to make a lot of sense. Now, one of those strategies, our fourth example, is a charitable remainder trust. And the way it works is that your client would donate the property to the trust, and then the property would be sold through the trust. Since the trust is tax exempt, there's no capital gains tax due on the sale. Additionally, since your client donated the property to the trust, they would get a significant charitable tax deduction. So with this strategy, you get to avoid the upfront capital gains tax and you get a deduction that actually reduces your tax bill. Now here's where the magic happens, because the trust can reinvest the sales proceeds in any asset from real estate, businesses, stocks, whatever it is, and then the trust can pay the seller, your client, whatever income that they specify in the trust documents. It can be a fixed amount per year. It can be a percentage of the trust asset or a percentage of the trust income for that year. And over time, your client's going to receive way more income than the value of the asset that they donated. Now, unfortunately, once the income ends, which is usually at death, the trust terminates and all the remaining assets go to charity and not your client's family. And this is a big downside to this strategy. But a little known secret is that there are ways to structure charitable remainder trust so that the family actually receives the same amount of money that's going to go to charity. Now, our fifth example is very similar to a charitable remainder trust. The difference is that the seller donates the property directly to a charity instead of a trust. The charity then sells the property and pays no capital gains tax because it's a tax-exempt 501c3. The seller also receives a significant charitable deduction, but the really cool thing about this strategy is that you completely eliminate a portion of the capital gains because the property is being sold by a charity. The charity then pays, your client a fixed income for a set period of time equal to the present value of the asset that you donated plus 5% give or take. So if you donated a $10 million property, for example, you'd probably get back $10.5 million over the payout period. So with this strategy, you don't have the immediate capital gain. You get rid of a portion of the capital gain. You get a tax deduction and you get back more money than the value of the asset that you donated over time. The best part is that none of the proceeds have to go to charity. If you pass away before the payout term ends, that income can go to a named beneficiary like a spouse or children. Now, example number 6, our last example, is a very unique strategy because it's basically a hybrid approach of an LLC and a nonprofit structure. Now, the way this strategy works is that an LLC is set up where your client, the seller, is 1% owner and the other 99% is owned by a charitable entity like a charity or donor advised fund. Now, your client would donate the property to the LLC, get a deduction, the LLC would sell the property, and the proceeds would go back into the LLC. Now, since the LLC is majority owned by a charitable entity, there's no capital gains tax due on that portion. So your client, the seller, would only be taxed on 1% of the capital gains, which is pretty insignificant. Now, eventually, the 99% majority money inside the LLC is going to go to charity. However, there are ways for the seller, your client, to free up cash to do whatever they want to do, buy real estate, vehicles, go on cruises, and just like the charitable remainder trust, there are ways to ensure that your family receives the same amount of money that's going to go to charity when you're no longer here. Now, I know this was a lot of information, and I could go on and on about different strategies and examples, but that's really not the point of this training. Again, my goal is to give you a better understanding of the options and alternatives your clients have to mitigate capital gains taxes without having to do a 1031 exchange. Remember, time and taxes are both you and your client's biggest enemies. And if you're not addressing both, you're just going to continue to be inefficient. Again, your clients don't need to get the highest listing price. They just need to find ways to reduce and mitigate taxes. And there are so many strategies and structures out there, from special purpose vehicles, private foundations, enterprise agreements, reverse mortgage trusts, all these different things. The list really goes on and on. The few examples that I just went over are really just scratching the surface. The point is that there are a lot of different ways for your clients to not only mitigate capital gains taxes, but sell their properties quicker and have more money and more control after the sale. And again, these things are not new, okay? Wealthy people have been using these things for years. The Rockefellers, the Clintons, the Waltons, and the list goes on and on. And all these people pay very little taxes. So if your clients are paying more taxes than these billionaires, there's something missing, okay? You have to think beyond 1031 exchanges. Now, I don't have a problem with 1031s, but I know a lot of realtors only like 1031s because it pretty much guarantees you another sale. And there's nothing wrong with that. But there are other ways for you to get a sale without a 1031. Look, there's a lot of things you have to consider with 1031s. First off, 1031s are not for everyone. What if your client doesn't want to be a landlord anymore? They don't want to have to deal with the tenants' toilets and trash, right? They want to move on to Corvettes, cruises, and cocktails. Maybe they're older and they want a way out of real estate. They just want a simpler life. Well, if that's a case, a 1031 is completely out of the question. But let's say your client does want to be a landlord. Are you going to be able to find them a decent cap rate? What's the inventory like? I know in most cities around the country, there's just not a lot of good options. And on top of that, are you going to be able to find the right properties for your clients and close in time? Maybe, maybe not. And unfortunately, about 60% of exchanges fail and become taxable because the client is unable to meet the identification and exchange deadlines. Now, you can always recommend a Delaware statutory trust, take cash out, opt zone, whatever. But what if your client doesn't want to be involved in real estate at all, period? What if they want to invest somewhere else? Well, then none of these strategies will work for your clients either. And what if your client is selling a primary residence, a development land, doing a flip? Or maybe they're selling an asset other than real estate, like, an aircraft, vehicles. Or they're selling shares of a business, like a partnership, LLC, corporation. If they're doing any of these things, they can't even do a 1031 exchange. Now, I could go on and on, but the point is, if a 1031 is the only option you're recommending to clients with capital gains, you're doing yourself and your clients a disservice. So by offering your clients more solutions to take taxes off the table, you put yourself in an entirely different category, okay? Real estate professionals that know about these unique solutions, outside of 1031s, they not only differentiate themselves, but they close more deals, they get more listings, they get more referrals because clients see them as more knowledgeable and educated. Put it this way, if you were a client, which broker would you choose? Broker A, who has the fancy brokerage with all the frills, but only recommends things like 1031s and DSTs when it comes to capital gains? Or Broker B, that doesn't force clients into 1031s because they have more options. So Broker B's clients aren't limited to certain properties, and they don't have to deal with the strict time limits to identify and exchange a property. And Broker B's clients can sell their properties, avoid the cap gains tax, and choose when and how they purchase their next investment. They're not rushed into the next real estate project. They can take their time, wait things out, and decide when they want to reinvest. Which broker would you choose? Well, if you would choose broker B, who do you think your clients would choose? Exactly. The point is, and as a real estate professional, if you're not presenting the right solutions, you're probably going to lose a lot of deals. Let me give you an example. We recently had a real estate broker from California reach out to us who was concerned about one of her listings that had a significant capital gain. Now, the background on this case was that this was a multifamily property located in Los Angeles, valued at around $30 million. And it was originally purchased in the 80s for around $200,000. Now, the seller did about $2 million worth of improvements over the years, but this is still a significant gain, right? Now, after closing costs and commissions, the client stood to profit about $25.8 million. However, after factoring in depreciation, the net taxable gain was about $27.4 million. Now, at 20%, that would only be $5.5 million. But when you add in California state tax, the net investment tax, and depreciation recapture, the client would actually have to pay $10,612,018 in taxes. That's close to 40% in taxes. Think about it. 40% of their profits were going to taxes. So at the end of the day, the seller was only going to walk away with $17 million. Now, that's still a lot of money, but they're also going to stroke a huge check to Uncle Sam. Now, the seller actually received a full price offer, but when they found out exactly how much they had to pay to the government, they backed out of the deal. And the broker was super upset because it took her almost 2 years to get the listing. So it's 2 years to even convince the seller to put it on the market. That's a lot of time. And out of all the issues that can happen before closing and can screw up a deal, taxes were the issue in this case. And I'm sure that some of you can relate. Now, the silver lining in this situation was that the broker reached out to us about 2 weeks after the seller backed out of the deal, and we were able to revive the deal and close within about a month. So the seller went from listing a property for $30 million, having a $10.6 million tax bill, and only having about $17.4 million left over, to being able to walk away with $27.4 million after closing costs, commissions, and the cost of setting up the tax strategy. That's a big difference. And we even showed the buyer how to mitigate taxes on the rental income without having to use depreciation. So the buyer and the buyer's agent were happy as well. So this was a huge win, not only for the seller, but for the buyer and both brokers. You get paid in direct proportion to the difficulty of the problems you solve. And taxes are a big problem for some of your clients. When clients don't move forward with the transaction because of capital gains taxes, it sucks not only for you, it sucks for the buyer, the title company, the attorneys. No one's getting paid. So just think about all the doors that will open for you if you're the one that's able to bring deals to the closing table and negotiate better because taxes are no longer an issue. If you're the one introducing your clients to these unique opportunities to not just defer, but save taxes, you differentiate yourself, you build more value, and the cost of your services is more than justified. Look, the real estate industry has always been changing, but it's going to change even more with all these NAR lawsuits and everything that's going on. So the game is going to change, and you're either going to be on the wrong side or the right side of that change. You're either going to fall to the wayside, like a lot of agents and brokers, or you're going to be on the cutting edge. And I can promise you that introducing your clients to these unique alternatives to pay less taxes and keep more money without having to use things like 1031s and DSTs, that's going to put you on the cutting edge. That's going to make you stand out. And you're going to be able to close more deals quicker. And remember, time and taxes are you and your client's worst enemies. And every month that goes by when a property is not moving because of the asking price or taxes, that's time and money that your client is literally flushing down the toilet. They never get that time or that money back. But when they're using more sophisticated strategies, your clients your sellers can get more money with a lower asking price if they're being tax efficient. And that's what our team does. So that's it. Thank you so much for taking the time to join me. I know it was a lot, but hopefully you have a better understanding of how to help your clients mitigate capital gains taxes without 1031 exchanges. Unfortunately, most investors fail to take advantage of these opportunities simply because they're unaware of these things, or they're too busy focused on the market, cap rates, comps. And I'm not saying those things aren't important. They are. But if you're watching this training, I'm assuming your clients already have that covered. And even if they have massive profits, taxes can kill 20 to 50% of your clients' earnings. So if you don't get the taxes right, nothing else matters. What sense does it make to earn a couple hundred or $1 million more and then give half of it back away in taxes? It's like taking one step forward and two steps back. And the sad truth is that most investors don't spend a single hour on tax planning until the last minute when it's too late, and that's usually when deals fall through. Now, again, most of your clients probably have good accountants, but what they don't have is a team of specialists that only focus on helping investors become more tax efficient and take advantage of these unique strategies. It's like the difference between a general surgeon and a general practitioner. They're both doctors. They're both important, but one is an expert in doing something unique and specific that the other isn't trained to do. And that's the same thing with us. And that's where our tax team comes into play, because you and your clients get to work with a group of experts that do this type of work all day, every day, and that only focus on helping investors with these specialized tax structures. We have a team of strategists, forensic CPAs, enrolled agents, and tax attorneys that have over 40 years of experience in trust law, tax codes, contract law. They've worked with some of the top tax and advisory firms in the country. We've been featured in Fortune magazine, and some of our team members are former law professors and IRS auditors. So our team knows the process. We know all the guidelines. We make sure that there's proper documentation, certification, and everything is audit ready and defendable so that your clients are in compliance. And that's huge, because the compliance part of this is so important for you and your clients to be able to sleep well at night and rest assured that things are done in line with the tax code. You don't want to do these things willy-nilly, okay? The IRS does not play games with this stuff, and they will try to make an example out of you if you screw up even a tiny bit. So yes, there is a process to this, but our main focus is to make that process simple and easy for you and your clients, okay? Simple and easy, because let's face it, the last thing that you or your clients need is another complication before closing. So our team is here to do all the heavy lifting so that you don't have to worry about anything. Now, our team does not partake in any real estate commissions. We're not trying to replace anyone's broker. And we work with your client's existing accounting team. We're also not trying to take anyone's accountant. So your team, they're great. Your client's team is great at their job. And our team, we're great at our job. This is a team-based approach. And it's one of the reasons why we partner with tax firms and brokers all over the country. So if you're looking to differentiate yourself and you're looking to work with specialists to help your clients mitigate capital gains taxes without having to do 1031 exchanges, then you may be a fit for our strategic partnership program. This program is for real estate professionals and business brokers that have clients with significant capital gains tax liabilities. Whether clients are selling residential or commercial properties, apartments, business assets, even if you have clients that do fix and flips or that are in the middle of a 1031 exchange, we can help them. This is for people that are looking to differentiate themselves and, again, close more deals and offer more solutions than traditional strategies like 1031 exchanges, installment sales, and things like that. And this is also for people that are willing to put in the time and learn from experts to help their clients be more efficient. Who is this not for? Well, if you don't have clients with significant capital gains, we can't help you, because these strategies really only make sense for clients facing a 6 to 8 figure or more capital gain. This is also not for people that are arrogant and closed-minded and not open or willing to learn from experts. If you think that you know everything, or that your accountant or attorney or other people that you work with know everything, even though you're probably not taking advantage of the things that I've discussed in this training, we can't help you. You have to be open-minded. And this is not for people that are transactional. Our team is looking to partner and build long-term relationships with brokers that are consistently engaging with clients. Again, our goal is to help build value and grow your business through our strategic partnership. So if that sounds like something you're looking for, then go ahead and click the link below to schedule a free discovery call and learn more about our partnership program. Now, once you click the link, you'll be taken to a calendar that looks like this to book your call. And then you're going to complete a few questions so that me and my team can review, just to make sure 100% that we can help you and that you're the right fit for what we do. And that way we can dive right into everything on the call. Now, there are a couple of things I want to let you know before you book the call. Number one, we're very busy. Okay, we get a lot of requests from real estate professionals all around the country, but we can only take a handful of calls per day, and we take those on a first come, first served basis. So book your call as soon as possible to secure a time slot on our calendar. Secondly, we cannot help everybody. So during the call, we'll be evaluating and analyzing, some of the current cases that you're working on, how to get some deals closed as soon as possible, and really seeing if it makes sense to pursue a partnership. And the sad truth is that there are a lot of brokers that we just can't help. And if that's the case with you, we'll be 100% upfront and let you know right away. Knowing that we're a good match is very critical, because results are the only thing that matter to us. And we're only looking to work with brokers and agents who we're 100% sure we can help. So at the end of the call, one of two things are going to happen. You'll either be a fit and we'll talk about next steps, or it's not a good fit, and that's totally okay too. And there'll be no hard feelings whatsoever. Either way, it'll be an extremely valuable call, and you'll be much more educated on how to help your clients take advantage of these different strategies and opportunities. Once again, I want to thank you so much for taking the time to join me. Again, if you have any questions, you can shoot me a text or send me a DM using one of the links below. And again, if you have clients that are looking to mitigate capital gains taxes, but they don't want to do a 1031 exchange, our team would love to show and educate both you and your clients on some efficient alternatives as soon as possible. Because again, every month that goes by when a property is not moving, that is time and money that you and your client are losing out on. So just click the link below to book your discovery call, and we'll see you on the other side. Bye.